CAPM describes the relationship between systematic risk and expected return for assets, particularly stocks. Let's take a closer look, firstly on definition, then on corresponding formula. Well, as I have explained, the CAPM model describes the relationship between risk and expected yield. In this model, the expected yield on the risk-free rate plus premium based on systemic risk of the security. So here is the formula. R equal to the RF, risk-free. So this is our return on the risk-free security, such as treasury bill or state bond, plus beta coefficient, U risk compared to the market risk, times RM, return on the market, less RF, again, return on the risk-free security. RM, it's about return on the stock exchange or some index such as S&P 500 index. So I will explain in more details each of such component. Well, the CAPM is very, very useful. It has its advantages, but also some limitations as it assumes the following assumptions. Firstly, the capital markets have to be effective. Secondly, investors have equal expectations and there are no investment restrictions. This is not always the case. In some countries, you have restrictions on capital or money markets. Then you need a risk-free asset or security, such as treasury bill issued by Ministry of Finance or some state bond. So those are risk-free securities. In the calculation of the CAPM, you also need some market security, market portfolio, which contains systemic risk, such as S&P 500 index, or I don't know, Dow Jones, Nasdaq if you are in USA, or CAC if you are in France, DAX Germany, Nikkei Japan, and many other stock exchange indexes.